So there's all these margins in business. There's profit margin, gross margin, which is which. So what is gross profit margin? Gross profit margin is your total revenue minus your cost of goods divided by your total revenue as well. And when I say total revenue, I mean total sales. That's going to give you a decimal point multiplied by 100. You've got a percentage. So what is let's start from the bottom as far as what's not great and what's really good. I would say 30% is not so hot, because basically that means 70% is going towards your cost of goods. Now remember, cost of goods is just to get the product or service out the door. That's not your overhead costs. That's not your rent. That's not your insurance. That's not your administrative payroll. That's not to turn the lights on, essentially. So that means for every dollar, 70% is already out the door, and you still haven't paid for all these other things underneath that. So that's why 30% is not so great. I would say 50% is healthy, because then you've got more room to handle those other expenses to run your business. What's a great margin? I would say 70%. That means it only costs you 30% of your total sales to get the job done, and then you've got the remainder to fill in on those other overhead expenses, and most likely you would have a pretty solid profit at the end of the day. All right, hope that helps.